Drew Stacy, First Place Bank. I'm just going to get right into lending. I'm going to do the first, most important thing in my opinion. No MI. MI is mortgage insurance. Some people call it PMI. Technically, it's all the same thing. PMI really only goes on an FHA loan, but it's all the same thing. MI, PMI, same thing. Most people are under the assumption that you have to put down 20% to have no mortgage insurance, or you have to do some split loan at 80-10, 80% on one loan, 10% on a second equity, to avoid paying any mortgage insurance. That is not the case, not with us. Very few other lenders in town know how to do this. One, very few other ones can actually close it. Two, and three, very few other lenders can even price it anywhere remotely competitive because they do not have the spreads and the rate like we do. This will offer you, and I'm just going to go over the basics. And anything in between. 5, 10, 15% down. No mortgage insurance. A couple things you got to keep in mind about mortgage insurance. If you make over $106,000 a year, you cannot write it off, period. That's the maximum amount that once you hit that number, you no longer have to contribute to Social Security. Well, the government figures that you no longer need the mortgage insurance write-off for yourself either. Some people will look at you and say, well, I'll just pay the first 7 years until I have my 20% equity. Well, one, it never works that easy with the banks because there's always a process you have to go through. They have to reappraise your house, and with things going the way they've been going, things have been going down. So there's no guarantee. Also, they're going to pay their mortgage insurance once, and they're going to be able to write it off for 5, 7, 8 years as long as they have it. It's not a good deal not to pay it.
You don't want to pay for it if you can't write it off?
I wouldn't.
Oh, okay, but you have to have it. Well,
no.
Oh, sure.
Well, you have the option of paying it, putting down 10% and paying it. Problem is, what that does on like a $200,000 loan, you're paying about $220. You're paying about $220 a month now that you cannot write off. So what would be better to take my slightly higher rate? This is about what the mortgage payment is on $100,000. Should be right around there. So if you take this deal, let's just do a 10% down deal. This is my 10% down. All this on $100,000. Your payment will be about $460 a month. No MI. If you take 10% down with MI,
and those are interest rates at 3.25 and 3.50. Is that what you've got written?
Correct. This will be at 3.5. This is at 3.25. So the rate's a little cheaper. When you decide to pay the MI, letting me pay the MI at 3.5. Look at the difference. And then that only multiplies. $200,000 house, $200 difference, and so on and so on. I mean, I don't even have to sell the product. Period. FHA is not much different. So let's do the same thing with FHA. It's going to be about $440 plus about $115 or so of mortgage insurance. This is about what FHA is putting you at. This is obviously the competitor in these programs. Here's the biggest problem with FHA. You guys all know the upfront funding fees there too. You don't know? You know it's there. Upfront funding fee. I believe it's 2.75%. So if it's an $100,000 loan, there's $2,750 tacked on the loan right up front. So it's costing you not only, versus, we'll say a 5% down deal, which would be like 3.625, be about $470 a month total.
What's the upfront funding fee?
Upfront funding fee. FHA tax that onto the loan once the loan has been completed. They don't have to actually pay the fee. Well, they do have to pay the fee, but they basically finance it into the loan. Basically what I'm telling you, if you can avoid FHA or paying mortgage insurance, this product blows it away, period. You guys grasping this? Mm-hmm. So let me just give you some minimum guidelines. They need a 680 or higher credit score to do it. If you're under that, you're going FHA, period, all the way.
There's no conventional loans under 680.
There are, but they're not worth it. The
Okay.
fee becomes so high
Okay.
that I can't even
Okay.
cover it anymore. The 680 credit score is huge. Obviously, the better your credit score, the easier it is for me to cover more of your fees. This is the same thing as refinances. We refinance clients all the time out of FHA, get rid of that mortgage insurance, drop the rate, no more funding fee up front. We have one loan here that we can do. I do not do them very often because it does not make sense very often, because a lot of times it's better just to, if you can put down a 3.5%, most people can put down the 5%. I can do a 3% down, no MI. This is more or less a direct competitor with FHA. Couple stipulations with this, it's real simple. If you do not have a 720 plus, it doesn't make sense to do it, and I can't really get it approved unless it's pretty much a 705 or higher. Doesn't make sense. But you get a lot of people with good credit that do not have a down payment. They have just enough. Another big thing to remember with these, this is the biggest one. So I will make it big. You need 3% of your own money must go into this. Must have 3% of your own money
Go into what?
to go into any of these. So if you have a 5% down deal, that's fine. 3% of it needs to be in your account.
Oh.
2%, the rest can be a gift. If you only have gift funds and you have a 750 score, that's fine. You're going FHA. Does that all come full circle now?
Mhm.